Hello and welcome to our webinar, continuing series on career and self-improvement webinars. My name is Samantha Schenk, and I'm a graduate assistant here in the William Patterson Alumni Office. Before I introduce our presenter, I'd like to go over how the webinar will work. First of all, you'll be able to view the presentation on your computer screen. You'll also be able to hear the presentation through your computer's audio system. Please feel free to ask any questions by typing them in, and we will monitor them and occasionally stop to answer. Any questions not answered in today's webinar will be addressed after the webinar is completed, so if we don't get to your questions, we will answer them either personally via email or in a group email. In addition, we're recording the webinar and we'll be posting it on the WP Alumni YouTube channel after the presentation is completed. And now I'd like to introduce today's speaker. Mark Moskowitz is a veteran of Wall Street with over 20 years experience. He's held various positions throughout his career, starting out as a financial advisor with Paine Webber. Mark began his own hedge fund in 2003 with average of returns over 26% through the life of the fund. He has been trading independently and teaching since 2009. In today's webinar, Mark will be giving you tips on how to manage your 401k, especially in the volatile market. And now, without further ado, I'd like to introduce Mark Moskowitz presenting Managing Your 401k, 4 Tips for Surviving the Volatile Market.
All right, thank you very much for having me on. Really looking forward to some great information. Hopefully, we'll be able to do some Q&A, so feel free to ask questions along the way. And I actually changed a little bit of the title just to encompass all retirement plans, not just only 401ks, because I know sometimes 401k is just a small part of people's retirement. So let's keep it to all different kinds of retirement plans. First, a quick disclaimer. The information that's going to be given in this seminar should not be taken as investment advice for anyone attending. All the information is strictly for educational purposes, and any investments should always be discussed with your personal financial advisor or someone that knows your specific investment needs. Edge Trading, LLC, or Mark Moskowitz or any of its affiliates are not liable for any decisions that are made by any investors on this seminar after the seminar is over. So, a little bit about who I am. Yes, I have about 25 years of Wall Street experience, my entire adult life. I did start out as a financial advisor, was a hedge fund manager, and now I'm an independent trader, meaning I trade for myself, and I'm an educator, which has really fueled a wonderful passion for me, and I do really appreciate the opportunity to be able to come on here and provide some information that my years of experience has taught me. And I consider myself to be an expert market technician, meaning that I look at the markets in a little bit of a different way than you might be used to. And part of what I'm going to ask of you today is to challenge yourself to think a little different as well. Challenge yourself to buck the status quo sometimes, because we're just in different markets than we've been in throughout history. And if you're going to retire comfortably, if you're going to reach the investment goals that you desire for whatever it may be, whether it's purchasing a home or college education for children, the old ways do work to some degree, but you need to have some new tools in your kit to really reach the levels that I think everyone wants to get to. What I say here in bullet point 2 is I have this real passion for understanding of how markets work. It's just always been something that was sparked in me young in my career. I started in 1990 as a financial advisor with Paine Webber, and then we got purchased by UBS. And I remember attending a seminar once from a company called Dorsey Wright, and it really changed my life. I don't know if anyone has ever sort of had that moment in time where you can say, man, something really just resonated with me and inspired me. And they taught me how to look at markets in a different way and how to see the true supply and demand nature of what's going on, because ultimately all the different types of analysis, and you can watch CNBC and you can listen to Jim Cramer, but it really all comes down to where are there more buyers and where are there more sellers, and that has really become my mission over the last 5-6 years since I've become an educator and starting to teach people, because there is a theory out there. I say the small investor theory, and that theory that people like myself, Wall Street veterans, we talk about it openly that we believe that the small investor makes mistakes 90% of the time. They buy high, they get euphoric, so they're buying the market in 2007, or they're buying real estate in 2007 and they're building condos and flipping at the wrong times, and then they're selling in the wrong times. They're selling in March of 2009 because they get scared and they get panicky. So my mission has become, how can I uncover ways that the small investor doesn't have to go through those fits and starts of times when the markets are just really tough to navigate, and how can they have more confidence in what they're doing, and how can they sleep better at night? Those are all the things that drive me every day as I'm doing my education classes. One of my important beliefs here is that investors are going to reach their financial investment goals but they have to be willing to raise their standards of themselves and of their trusted advisors. And what I mean by raising your standards means that you just can't sit back and accept the status quo anymore. You just can't sit back and say, okay, the market's down, it'll come back, life will be fine. You have to become a little more proactive. I am not saying that you have to be a day trader or anything like that, but I am saying that the days of just sitting back and hoping and waiting for everything to work are over, and I'll explain that in a little more detail as we move along. So this starts with increasing your knowledge and knowing what questions to ask, and using your financial advisor as a tool to help you be a better investor and reach your financial goals. So I thought that I would just start really quick by giving the current state of the markets. I don't know how closely everyone's out there watching. I will say that in my experience, people watch the markets more closely when we're going down than they do when they're going up, right? They get a little panicky. They're not really sure what's going on. So this is a chart, and I'm a market technician, as I said, so I use charts to make my decisions and my analysis. And you can see that it's been very choppy. This goes back to about February of last year, so almost a full year. And you can see the markets haven't really shown much in the way of any great direction. We had a big sell-off here in August, which you probably all look, if you looked at your 401k or IRA statements at the end of August, you had a little sticker shock. And then it rallied back nicely, and then into the end of the year. And then since 2016's begun, it's been quite choppy as well. So the markets are certainly tough. We're not in bear market territory yet, but we are downtrending, and I determine the trends by using some of this red line here, which is my 200-day moving average. When we're below that, that tells me that we're downtrending. And then I also want to show this last slide on the charts. I don't want to get into too much of technical analysis. That's not what we're here for, but I do want to just give you a general overview. This is a monthly chart, meaning that each one of these, what we call candles, so this green candle, this red candle following, that's a 1 month snapshot. So you can see we go all the way back to 1994, right? So we're getting 22 years of data here. Now what I want you to see is when markets go up, they go up very smoothly and they go up very easily. Maybe you get a little small move here and then they go back up again. But when they come down fairly harsh. So markets go up about 75, 80% of the time. But the problem is when they come down very strong, and you can see you give back a lot of your returns. So in this case, you had from 1994 to 2000, you had 6 years worth of returns. Half of that was given back in about a year and a half, 2 years. And then from 2002 up to 2007, you had a very solid market, and then in 18 months, you gave it all back. And here we are again with a very strong methodical move, but you could see how just by looking at a chart, you don't have to be a great technician to see that there's a lot of difference between what this looks like here and what the preceding 6 years were looking like before that. So my job, what I do every day, is I look for times when the markets are going to be more volatile, and then that's how I will manage my longer term assets. So even though I'm not necessarily day trading my longer term assets, I will make determinations based on how much cash I want to have by what I'm seeing in the charts. So I want to just give a quick overview of that. The markets. I posted a video up on YouTube, and I'll give you my YouTube channel at the end of the presentation. I posted it back in June of 2015, and the title of the slideshow or of the presentation was why I believe the market could have a 25% pullback. And there were certain things that I saw and noticed because I am what I consider to be a market expert. I do pay attention to these markets very closely, and I wanted to get people out there understanding that there are certain times where you need to be a little more hedged and you need to be a little more conservative, and then there are other times where you can be full throttle on. So one of my missions here is that when the markets are up here like this, I don't want necessarily everybody jamming into the market, because what happens is they buy it here, the euphoria happens, this is how bubbles get created, and then they get panicky and they sell here, and that's why we're having less participation in the markets from people overall. And if you look at 401ks, because that's a lot of our topic today, 401ks have a tremendous amount of cash in them, which is good for today's market, but it wasn't very good from 2009 up to 2014. You missed a lot of return. So my goal is to get everyone here to become smarter investors, to be able to understand when the markets are getting a little toppy, a little peaked up, and then also when markets are cheap and you should be investing fully in them. So that's just a little bit of an overview of what I do and how I look at things. So let's get into the tips that I believe can really help you to manage your retirement assets better in markets that are volatile like this. And when I talked about raising your standards, the first thing of raising your standards is you need to know exactly what investments you have in your accounts, whether it's 401k, IRA, personal account, whatever it is. You need to be more knowledgeable of your investments, which means you need to be a little bit more proactive. And I recently have a new client, this woman who just was so frustrated with her Merrill Lynch broker. She couldn't get answers. She came to me. She hired me to be a consultant for her. And in our first meeting, I just explained to her she had 11 different mutual funds, and she thought she was very well diversified. And we dug into the funds themselves, and when she looked at what the holdings were, she was shocked at how much overlap there was. And that is one of the problems with mutual fund investing, is we think, okay, we've got, Vanguard small cap, and we've got Vanguard large cap, and we've got, this global fund, and we've got these different things. But all of a sudden you realize when you look that Amazon's a part of the large cap and the global, and Netflix is, and so on and so forth, and you realize that it's much less diversified than we think we are. So because most 401ks and company-sponsored retirement plans use mutual funds for their main source of investment vehicles, it's very rare that there's a 401k out there where, unless it's a self-directed 401k, where you can buy Apple stock itself. You need to buy it through the mutual funds. So, but the problem is that a lot of the holdings do overlap, and they provide less diversification than the investor truly believes in. And this really only becomes apparent when we have bear markets. I remember a time when I was a financial advisor back in the late 90s, early 2000, before I started my fund, where I would meet with clients or new clients, and I'd say, tell me what's in your account. And I'd say, oh, I'm very well diversified. I have IBM, I have Cisco, I have Microsoft, and I have Intel. And that'd be their whole portfolio. And it seemed diversified because you had 4 different stocks, and maybe in some sense that is diversification, but stocks are very highly correlated to each other, and that's the second point here. And I talked about Dorsey Wright for a second. This is also something that really changed my life, is understanding this study that was done in the University of Chicago by Benjamin King in 1964. And in this study, they figured out that 80% of a price movement in a security, particularly stocks, comes from the movement of the broad market and the sector. So what that means is 80% of the time when a stock is moving, it has nothing to do with the stock. It has to do with what's going on in the overall market. So that means that you could be in Johnson and Johnson, and you could be in Apple stock, and you could be in IBM, you could be in a bunch of different names, but they're all going to move roughly the same way 80% of the time. That is not what we would call a diversified portfolio. That is a portfolio of where we're sort of hoping that we just continue to go higher. So it's a study that also got me thinking about how can we do better as investors in the longer term. So, and then the last point here on this slide is when you're researching each fund, dig into those top 10 holdings to make sure you're not getting overlapping names. In Barron's, there was a Barron's article back in December 2014 that said in 2014, 23% of the top 100 largest mutual funds by assets had Google, Apple, and Amazon as part of their top 10 holdings. That is, again, if you're sitting with any of those funds, you're very heavily weighted towards those names, and that's, to me, when you're in a strong upward moving market, that is reasonable. But when you're in a potential bear market or a potential 2008 sort of looking market like we do have right now, it's really tough. I mean, in 2008, the markets were down 45, 50%. It's very hard to deal with that and feel comfortable that you're going to be able to get towards your retirement goals. So some remedies that you can do. The first thing I would say is you have to be willing to ask your advisor questions. And one thing I've learned from some of my students in these classes is they don't know what questions to ask, and they don't want to. They want to look at their advisors as they know what they're doing and they're comfortable with that, and that's great. But you need to be comfortable. You need to be able to sleep at night, and you need to be able to ask questions about what you're in. Make sure it's truly diversified, which we'll talk about in the next tip. Understand your risk, because when you have a long-term outlook, right? Let's say you have 30 years to retirement. You don't really need to look at the market every day and see what's going on, but there is risk involved, and just simply buying and holding is not necessarily been very good over the last decade and a half. So you want to understand the risk, and hopefully your advisor can explain the risk to you. And you want to do this with every decision you make and every different time frame that you have. So if you have a college education coming up in 8 years, it's going to be a little different than if you have retirement in 30 years, and you need to be thinking about those. You need to upgrade your education on that. Use online resources like Yahoo Finance to research each of the funds you're in, understanding their top holdings. We just talked about that, how important that is. Look at historical performance. Is the fund performing well when the markets are performing well? If they're not, if the stock market's up 15% and you're in a fund that was up 3%, that's a stock fund. Well, you need to be out of that. Clearly, the manager's not doing a good job of picking and choosing their investments. You also want to be diversified to style. There's a style box known as large cap growth, large cap value, small cap growth and value, and mid cap. You want to have a little bit of each of those. But again, remember from the study from before, 80%, even if you're diversified there, is going to move in roughly the same direction. And I think you want to be reviewing your performance on a monthly basis to make sure that your investments are performing in the manner that you expect, so you can get to retirement or whatever your investment goal is comfortably. And a lot of people do not do that. They maybe look at things quarterly, semi-annually. Maybe they don't look at things at all. I don't know. Everyone's different. That's on this call, of course. So, but I think that at least a review monthly is important. You don't have to look at it daily, but I think that the more you pay attention to what's going on, the more you're going to realize how your funds are going to hold up in an environment that might be less than a great bull market. And one thing I get a lot from people is that their advisors tell them, "Oh, don't worry about it. Don't look at your statements. It's just short term. We're looking long term." I'm saying this tongue in cheek to fire them. I don't really think you need to fire them, but I think you need to tell them, "Hey, I believe in the long term. I'm sure we're going to get there, but don't tell me to not look at my statements. I want to know what's going on. I'm a more proactive investor than the average client that you have. I want to be involved. I want to know what's going on, because the people that are not involved, that don't know what's going on, those are the people that all of a sudden they're going to wake up 15 years from now and they're not going to be able to retire. They're going to be stuck because they don't have the assets that are going to provide enough income for them in retirement. Again, feel free to shout out any questions. I'm happy to go along. So tip number 2, true diversification means non-correlated assets. So in the Benjamin King study, it tells us that stocks are highly correlated, and that only 20% of the time they're really acting upon their own information. And in bear markets, stocks are going to correlate even higher. I say that most correlations go to 1 when you're in bear markets. Non-correlated assets are going to move independent of each other most of the time. When they move in the same direction, it's really a coincidence. So what is known as modern portfolio theory can reduce your overall risk in investment portfolio and boost your overall returns by investing in combinations of assets that are not correlated to each other, meaning they don't tend to move in the same way at the same time. So some great examples of some funds you might be able to purchase in your retirement portfolios are gold funds, or any sort of commodity, or any sort of metals funds: gold, silver, palladium, platinum, real estate funds, currency funds, commodity funds. These are examples of non-correlated assets. One of the things I found when I was a financial advisor was a company called Campbell and Company, located down in Maryland, and they ran what's known as a CTA, or commodity trading advisor, and their pitch was that we are going to be your one non-correlated asset, and that's what's going to help you do well when the markets are not doing well. And it really worked out very, very well. So if you go to campbell.com, I think it is, you can, it's not a pitch for them, but you can find and see how their performance has been and see the idea of non-correlated assets. Again, I'm not giving investment advice. Please understand that. Every person is different. But I believe it's reasonable to have somewhere between 10 to 20% of your assets in non-correlated performing asset classes. Now, I will say there's one, what I call a modern problem, and that is lately everything has been so correlated that even non-correlated assets have become somewhat correlated. For example, oil and stock prices, which you might think have really nothing to do with each other, they've had about an 83% correlation over the last 5 months. That means out of the last 100 trading days, 83 of them, they've moved in the same direction. We used to say this kind of in a funny way back in 2008 when the markets were cratering, because it was all about currencies, it was all about banks and stuff. We used to say we're all currency traders because it doesn't really matter what stocks do. They're just gonna move to what currencies do. And it sort of feels the same way in this day and age, that we're all oil traders, regardless of what the actual stock movements are doing. It's really based on what's happening with oil. And every time Iran or OPEC come out and say something, then oil moves one way or the other, and stocks tend to move exactly with that.
Mark, hi.
Yes.
Sharon, we have a question.
Sure.
I know you're not giving out, specific advice, but this person, you talked about taking risks. This person is saying that they're in a 457 ICMA and will be 60 years old this year. And her advisor is telling her not to take too many risks since she's close to retirement. And most of her investments are 2020 investments. She says she looks but doesn't make any changes. And is that realistic because she's so close to retirement? I mean, I know you take advice, but like.
Sure. I think that you have to, obviously you don't really want to be taking a lot of risk if you're 3 or 4 or 5 years away from retirement. But one of the risks in retirement is that you have to use your capital, your principal, to survive in retirement. So you need to have some level of growth, and without really knowing the specifics, in other words, I don't know how much money's in there, nor should you tell us on this call,
Right.
but without knowing those sort of intimate details, it's hard for me to say. But but you do need to have your assets grow because look, we're just living longer as a people, right? I mean, when they started the Social Security program, the average person was living to 70 or 71, so they figured, okay, they'd have Social Security for 4 or 5 years. Now people are living to 80, 85, 90 years old. So if you're going to retire at 65, and again, I don't know exactly this person's retirement age or when they're doing it, but if you're retiring hypothetically at 65 and let's say you live to 80 or 85, that means you have to be able to produce enough income without drawing down your capital for about 15 or 20 years. So there does need to be some level of risk in there that will help offset some of that capital that's needed over time, right? So I'm just going to make it up because I don't know the numbers. Let's say you have let's say that you have $1 million in this portfolio and you're going to get 4%. So that's going to produce $40,000 a year of income. But if you need $70,000 a year of income and you have a $30,000 a year shortfall, well, that money's going to have to come from principal. So eventually you can draw down on that principal. So in 30 years, you would have no principal left. Plus, every time you draw down on principal, your 4% is 4% on less and less assets. So my point is you need to have something, maybe at your age, maybe at your stage of the game, maybe it's 20% in some assets that are a little bit more risky, or 10% or 15% or something like that. So I hope that kind of answers the question without really knowing a lot of the specifics. I'll give out my contact information at the end, so if this person wants to reach out to me, they're certainly welcome to.
Great, thank you.
Is that good, Sharon?
Yep, that's perfect. Thank you.
Okay, great. So some remedies to the second tip, and that is if you're in a 401k and you're bound to their fund selections, you can look in there. There probably are some selections that are relatively non-correlated. You might need to speak to the advisor on the plan, and so see what kind of maybe real estate funds are available, or commodity funds, currency funds. Those should help smooth out some of the rough spots. If you are able to self-direct, either in an IRA or a self-directed 401k or whatever you may have, there are some ETFs out there. I would recommend doing a lot of research on your own, but IYR is an ETF. That's a real estate ETF. GLD is gold, and USO is oil. So you should do some more research, and as I said in my disclaimer, you should discuss that with whomever your trusted financial advisor is before you make any decisions like that. But it's a great way to have at least a percentage of your assets in returns like that. Funds that pay some higher dividends, so you could be looking at some fixed income and maybe some higher dividend growth funds, are a great way to add some income and some diversification to your portfolio. And at certain times, cash is your best non-correlated asset, right? So if everybody on this call, if this call was going on back in 2007 and you believed what I was saying and it made a lot of sense, sometimes taking 20 or 30% of your portfolio and going into cash with it saves a tremendous amount of headache and pain on the down move, and that's money you can deploy back into the funds when it looks a little bit safer to do so. So sometimes cash is a great non-correlated asset. And then the third tip to helping you retire and reach your financial investment goals is it's time to increase your knowledge. It's time to what I call skill up. We all need to become better at understanding markets. We all need to become better at understanding where our portfolio is and how we're going to get where we want to go. We need education. A statistic according to the National Financial Educators Council, 76% of people, I think it was like a 4,000 person study, gave themselves a grade of C or less in their investment knowledge and really understanding where they are in the scheme of things. And I believe a lot of this has come because financial advisors don't necessarily have a vested interest in wanting to field your calls all the time about what the market is. Unfortunately, the financial advisor at the large institutions has really become more of an asset gatherer, and they want your assets. They want a small fee to manage your assets, and then they want to just let it kind of go, and they don't want to have to be taking phone calls a lot. And I see this all the time, unfortunately. So, but it's up to us as individuals. It's up to you as the person who ultimately is going to succeed or fail to take matters into your own hands and to be better about it. And when I say this is not our grandfather's market, what I mean by that is, the period from 1950s up to 1986, 2000, it was just the Industrial Revolution was great. You could have bought Coca-Cola and Merck and some really easy names to buy, and just owned them, and you could have been multi-millionaires. So the statistic that I think is extremely important and for you to understand is what I say here. In the 15-year period from 1985 to 2000, the S&P 500, which is a broad-based index of stocks, returned a total of 1,300%. That's a great return. So $10,000 became $130,000. But in the last 15-year period, from 2000 to 2015, the S&P 500 returned only 32%, and that's total. So that means 10,000 became 13,200. So what does that mean? It means that the days of where you just buy something and kind of forget about it are over. You need to be a little more proactive. You need to be able to not hope that you're going to get where you want to go in retirement. You have to know that you're going to get there. We all are understanding what's going on in the economy, and that even the U.S. government, which is, of course, very solid and is never going to fail, but we have a tremendous amount of overhang of debt. We're nearing $20 trillion of debt and over $100 trillion of unfunded liabilities, meaning Social Security and health care. So you need to be more proactive. You can't count on Social Security. Again, I don't know everybody's age out there, so I'm saying a generalized you. I'm 47 years old, so I have no thoughts at all that I'm going to ever be able to take any Social Security. And I think that's just the way I have to think. So you need to increase your knowledge. You need to understand how markets work. You don't need to be watching it every second of the day, and you don't need to spend hours and hours taking classes. But what you do need to do is you need to think about it from a long-term plan. You need to get some more knowledge. So one of the things I think is very important is the rule of 72, and Albert Einstein said compound interest is the eighth wonder of the world. The person that understands it will earn it. The person who doesn't will pay it. And this correlates something called the rule of 72. And this is a rule that basically tells you how long it takes for your assets to double. You take the average rate of return and you divide that by 72. So, for example, if you're earning a 6% return, it's going to take 12 years for your assets to double, assuming you leave it in and you compound the interest. The more time you have and the more return you can average, the wealthier you're going to retire. So everyone can right now look at their portfolios and see where you are and see how old you are and how much longer you have until retirement, and what's been your return over the last 5 or 10 years. And take that number and see how long it's going to take for your portfolio to double. And if your portfolio is going to double 2 more times, where is it going to be worth when you become 65? If it's going to double 4 more times, then you can look at that number. But the problem is, as I stated in the last slide, is that even 1 year like 2008 or one 15-year period like we just experienced absolutely kills overall performance, because you're not taking advantage of compound interest. So you need to increase your knowledge. You need to be more proactive to make sure that you can deploy some cash, or you can deploy some non-correlated assets that will help you to reach those retirement goals. And if you don't, I don't want to be harsh, but if you don't, then you're taking a big risk, right? Risk is, as the question was asked before, risk is very it's arbitrary in a sense, because what's more risky, buying some stocks or running out of money before you die, right? So you need to have assets that are going to work for you, and you need to have some knowledge of how to deploy those assets at the right time. So I've just culled it down to a few topics that I love to teach on, and topics that I think are important. The first thing is you need to learn some basic technical analysis like I was showing in those charts. You need to understand when risk is high and when risk is low. And that is really what I do all day long as a technician. And if I'm trading for short-term gains, or if I'm trading for long-term investing, I still want to understand the risk that I'm taking, and hopefully the reward is consummate to equal that risk. Options, it's not necessarily something you're going to be able to use in a 401k, but if you have an IRA, or like I said, some form of self-directed 401k, being able to use options to hedge is a great way to do that. Options are risky, there's no doubt about it, but when you know how to use them, they can be your best friend. Shorter term trading solutions, these are very non-correlative to the markets, and I do teach a class in short-term trading. I'm not talking necessarily day trading, but for those of you that are interested, it's a great way to make some money. It's a great way to understand what's going on in the market. So if you have a knowledge for the markets, understanding some short-term trading solutions are great. Adding some fixed income, adding some commodities, which we've talked about, and then sometimes using individual stocks to help you get more growth when needed. So I think if you can get a nice background of knowledge in these 6 topics, you can be so far ahead of the game that that's where your edge is going to come from. That's how you're going to virtually guarantee your ability to retire in a much greater state. And that takes us to the last tip number 4. And this is what I call being non-directional. Directional means that you have most of your assets tied to one move or another. In other words, most people are bullish directional investors, meaning they're investing in hopes that the markets are just going to simply go higher over time. But I think, hopefully, I've pointed out to you that in this last 15-year period, markets have changed and markets are different. And I don't know if it's ever going to change back again, because right now we've become very, one negative to the way technology has happened over the course of our lives is it's made everything more efficient, which is good, and it's also not so good. So the reason why markets can go up is because there's some lack of efficiencies there that people take advantage of. But when everything is very efficient, markets can move at a whim very quickly, and we've seen that in 2008. We're starting to see that this year. So,
I'm sorry, there's a question here that somebody wants. Like, where can you start just to gain your basic technical analysis? That's the question. I'm not sure if I'm understanding that correctly.
Sure, no, that's a great question, and there are a lot of books on the topic. One author that I like, his name is Martin Pring, P-R-I-N-G. It gives you some basics. You can certainly use the internet. I teach a class on that, so that's certainly something that I'm skilled in educating people on. I think you can get a lot from books, but I think you can only get so much from books. Everyone, if you're really taking to what I'm saying, then I offer myself out there as a mentorship and as a consultant to help people get the knowledge that they need. So, and I'll cover that just in a minute when we get through this last tip.
Okay. So I just want to say, I see on the last line of your last tip here, someone has a question about that. So when you get to that,
okay,
come on back.
Sure. Okay. So I believe that even if you could find an asset class and have an allocation of roughly 10% that can go up when the markets go down, that is what I would call non-directional. So you might have 80 or 90% of your assets in bullish investments. But if you can even just have 10 to 15% in an asset class that can actually go up when the markets go down, you'd be shocked at how great that can help your performance. The market was down 40-something% in 2008. If you just had 10% of your assets in an asset like that, your negative return would have been a 15%, which is still terrible in my opinion. But it's a lot better. It's a lot easier to recover from that. Going back to that rule of 72, if you lose 40% in 1 year, let's say you have $100,000, and you lose 40%, now that $100,000 is down to $60,000. Well, you need a big return just to get back to $100,000. You can't afford to do that. So I equate having a non-directional asset to having home insurance or auto insurance or life insurance. It's something you have. You don't really ever want to take advantage of it, but it's something that you need to have because we all know that sometimes things happen. So having what I call an inverse ETF, an inverse exchange traded fund, or some sort of security that can be short the market can be insurance during a bear market. So let me just quickly say what it means to be short. This is a strategy that benefits from a down move in the security. Basically, you're selling the asset before you actually own it. So you're selling it in the hopes that you can buy it back at a lower price. So if you knew that that the housing market was about to crash, and you went out and you said to someone, I'm going to sell your house for you at this price. They said, okay, great. I'll take that. And then you knew you could buy it back at a cheaper price. 5 months later, you could make a nice killing on that. So it's the same kind of concept there. So, and again, this is just a typical general long-term portfolio. This is not investment advice. Like to explain that as many times as I can. So, a typical long-term portfolio. Long-term meaning, longer than 7, 10 years, something like that. 60% in stocks is great. 15% in some non-correlated assets, and maybe 5% of that could be fixed income. But 10%, like I said, perhaps in commodity funds or real estate funds. 10% in some sort of short positions, and then a little bit of cash for a rainy day. Sometimes that cash position goes up. That's what I do as a technician. Sometimes I want to be half in cash because I want a lot of money because the market looks like it's rolling over and doesn't look very good. So so that might be a typical an example of longer term portfolio. So go ahead, Sharon. What's the question on that last line? Sharon?
I'm sorry about that.
No problem.
They were saying this is a typical long-term portfolio. What would a short-term, like less than 10-year portfolio look like?
I would probably take about 20% of that stock portfolio off. So I'd maybe be like 40% stocks. Probably jump up the fixed income portion to about 20 or 25%. Then the balance in non-correlated and some short positions, and then some cash. So I'd probably go. I didn't put fixed income in here. That was probably an error on my part. So I put that into the non-correlated stuff. So I'd probably take 20% off the stocks. If let's say you're north of 5 years, right? 5, 6, 7 years. Right. So I'd probably do 40% stocks, 20% fixed income, and then the balance sort of the same. And then as you reach, I didn't talk about this today because I didn't want to go so much over our time, but the managing of your allocation is something that you do need to do almost on an annual basis. I do think you should be looking at your portfolio monthly at minimum, but as you get 1 year closer to, especially towards a shorter term goal like 6 or 7 years out, you should be tweaking those assets. And the one thing I'll tell you is that when the markets are doing great, like let's say you have pegged in there an 8% return to get you to where you want to go. All of a sudden the S&P has a great year and you have a 15% return. Well, don't just sit there and pat yourself on the back and be excited about it. Take some of that extra layer off for the rainy day, right? Take that extra 7% that you almost, 90% more than you really were hoping to get that year, and deploy that to fixed income or deploy that to cash. There's so many people I see that they don't manage that expectation, and they don't think about it from that longer term move. So if I'm looking at, I want 10% returns for the rest of my life. If I get out there in a 22, 25% return, I want to book that. I want to take that and be very, very happy, especially in a retirement plan where you don't have any taxes to pay until you take the money out of the IRA. So again, if you're in a 401k, you need to call your advisor, your plan advisor, and see if there's any funds that can be short in the markets. My gut is probably not, but you never know. Sometimes 401ks have been offering hedge funds lately, so that might be something where you can look into that as well. If you are self-directed, again, you can use ETFs like an SDS, which is short the S&P 500, or a QID, which is short the NASDAQ. And these ETFs are going to go up when the markets go down. So it's a great way to work on hedging. These concepts are very, very different. But remember what I said when I talked about raising our standards at the beginning of the lecture is that you need to think differently if you want to get to where you really want to go. And that is my mission. That is my passion in what I'm trying to do, is to get people to think a little bit differently, think for themselves, be more knowledgeable, be more educated, and that sort of takes me into consultation area here. So for everyone on today, feel free to email me, and we could set up a 1-hour consultation. I'm located here in Millburn, New Jersey, so if you're local, we could set up some time to get together. If you're not, we could do it over Skype or over the phone, and we can go over the current state of where you are invested, and the goals you have, and we can see if any of the courses that I offer can be a good fit to you. I have 3 websites depending on really what your goals are. For those of you who do think that earning an income from short-term trading, you go to Edge Trading. I will say something quickly that's interesting is when I first started educating people on trading, it started out initially as being people who really wanted to just day trade for a living. But over the last 2 years, I'm shocked at how many people who have full-time jobs just want to earn a little bit of extra money every month and have some security and have a career that they can fall back on in case something doesn't work for them. So short-term trading is Edge Trading. Longer-term investing is Edge Investing LLC. And then I just created this new website, and it's edgefinlit.com, which stands for Edge Financial Literacy, with a slant really towards investing literacy. That last site is probably going to be most relevant for everybody on the call. But again, you can check out all 3 sites. But that one, I offer a very reasonably priced webinar format. So we do all the courses online, so you can watch from home, and they're usually done in the evenings, so after work, and it's going to provide a great knowledge of technical analysis, fundamental analysis. It's going to talk. The presentations go very, very deep over the course of 3 nights, not consecutive nights, but it's roughly 9 or 10 hours of education. And you go through that course, and you will be 500% more knowledgeable than where you are today. And even if you are a very knowledgeable person, I'm still willing to make that comment, because the tools and the tips that you're going to learn in there are great. For those of you who want to follow me on social media, Twitter and Facebook pages, the YouTube channel, I would definitely love you guys to go and check out that June video that I did on the market falling 25%. And then, like I said, it's a complimentary consultation. Love to chat with each one of you. It'd be great. Feel free to write down my email address, or you can reach out to me by phone, and we can set something up. So,
Mark,
I know we did a couple of questions, so let's continue on.
There's a few questions. One is very simple, I think. What is a self-directed 401k or IRA? Can you just give a good definition of that?
Some companies will allow you to um, roll your 401k into another brokerage firm, and you'll make your deposits through that. So self-directed means that you could choose any asset that you want within your 401k. So let's say hypothetically somebody works for, I don't know, Merck, and they use Fidelity as their 401k. Well, essentially you're going to be able to use Fidelity funds only in your 401k. But if you have a self-directed IRA or self-directed 401k, then you have to roll it out of the plan. You still get all the benefits of the 401k, but then you can make the decisions in the plan. You could decide, I want to buy stocks, I want to buy this fund or that ETF, or do anything you want. So you're directing it yourself.
Okay.
The IRAs are typically self-directed on their own because IRAs in your own name. It's not in a. So there's a difference between company sponsored, right, like a 401k or a 403b. If you're an educator, those are sponsored by the company, and they're going to limit you to the number of investments choices that you have. So anything that's self-directed, you can make it your own choice.
Thank you. And this other question is, this person their company has been purchased by a Belgium company. She has a 401k with a U.S. investment company. Is there anything she can do to keep the 401k in the U.S. versus transferring it to the European fund that the company is now offering? Can you do that?
You would have to call human resources and ask them. I guess every company can be different in that respect. Are they offering only a Belgian suite of funds or a European suite of funds to choose from? And is she located in the United States?
He's located in the United States, but has been bought by a Belgium company, and she wants to keep her 401 with a U.S. investment company.
Well, then what I would do is I would call human resources and find out what your options are. That might actually be the perfect option to become a self-directed 401k. So you could even ask that question: can I roll it into either my own IRA? Can I open up a self-directed 401k? Are there any other options for the U.S. Employees?
Yeah, it says only EU funds, only EU funds. So, okay. Well,
yeah, I would reach out to human resources.
Okay. I don't see any more questions right now, but we're heading towards 1 o'clock, so I want to close it down. But I just want to tell everybody who's on here that Mark has a really good YouTube channel with a lot of really good videos on it. So you definitely want to check that out. And thank you, Mark, for doing this. And I think I see another question.
All right, good.
One more question for Mark. Company pushes a Monte Carlo analysis. What is that? Do you know?
That is, I do understand the Monte Carlo simulators. That's actually a very interesting concept. I'm not exactly sure how to answer that. Basically, they're trying to get you to see all the different possible outcomes of your decisions and the impact of risk on those decisions, which I always think is good because as you guys could probably tell from this point, I believe that most people don't reach their goals because they don't know the risk of what they're getting. So I do think that having the Monte Carlo simulations can help quite a bit, but in the end, they're still just simulations, and there's not always there's always it's very difficult to predict the future, of course. Mm-hmm. So you do need to take those simulations with a grain of salt. It's like a lot of times I'll have someone who will come to me as a trader and they'll want to trade capital for me, and they'll say, well, I back tested this information, but it wasn't in real time, and it can be very different here and there. So I like the fact that that a company's actually talking to them about Monte Carlo simulations, but as I would just say, take it as somewhat of a grain of salt, but certainly use it as a guidepost for how much risk you have in your portfolio.
Okay, and there's actually one more. Would you say a 4% loss for last year is not a good return? That's kind of a
4% loss. tell me, can they quickly tell me sort of what their asset class mix was?
If you heard that, type that in right now. I can actually.
General asset class. I mean, or is that just their? I mean, the S&P 500 was down about 3 or 4% last year, so you're probably about in line with that.
Mutual fund stocks and an IRA.
Okay, so um, I'm struggling to answer this one. I'm usually not at a loss for words. So here's how I'm going to answer it. So here's how I answer things.
Okay.
I can't stand losses, right? I'm like Gordon Gekko in the movie Wall Street. I don't like losses, bud. So um, I believe that my, the reason my company is called Edge is because I believe I have a great edge in this market, and I make money every year, and I make positive money every year, and I don't accept losing years. But that's because I have 25 years of experience, and I know how to go about doing it. But when you talk about the rule of 72, and when you talk about your overall performance, a down year becomes a big part of that. It sets you back. So what I would also ask this person, and maybe they don't know the answer off the top of their head, was you should have outperformed in 12, 13, and 14, 2012, 13, and 14. So if you did that, I think I'm going off the top of my head, but I think 2012 the S&P was up about 16%, 2013 was up like 20 something percent, and 2014 was up 18 or 20%. So if you outperformed in those 3 years,
yes, she did very well.
okay, good. Then that at least tells me that you're roughly in a market, you're in a roughly market environment of securities. So I can live with a 4% down year if I'm making money in the really good years. What I get uptight about and upset about is when I have someone come in and meets with me, and they didn't have good years when the markets were doing well, and then when the markets did badly, they had a bad year as well. So that tells me that something's really, really wrong, and they need crisis counseling almost immediately. So
Okay.
so as long as you're doing well in the good years, but the one thing is when a year like 2008 happens, you don't know it's going to happen until it's too late. So that's why you need to be a little bit prepared for that by using some of the tips I gave you today.
Do you think we could ask one more question?
You don't have to end at 1 o'clock for me. I can go all day, so it's up to you.
People, yeah. Regarding taking profits out from a good year, what's the percent number that defines a good year? Regarding taking, yeah.
Well, the example I was giving before was if you have a target number for the year, right? Let's say you've done some work and you realize that if you can hit 8% a year for the next 15 years, you're going to be able to retire in great shape. So let's say hypothetically you have a 12% year. So you've actually had a 50% greater return than you were expecting. That would be, to me, a reasonable amount to take out and put away in cash for that rainy day. Mm-hmm. So it's a little it's relative to what your expected performance returns are. Now, maybe people don't even have expected performance returns, which hopefully gets you thinking in that mode also, and thinking about, hey, maybe I need to have, now that I know what the rule of 72 is, I can figure out that if I get an 8% return, my money's going to double every 9 years, and I have 20 years to retirement. That means I'll double twice. That means I go from 200 to 400 and 400 to 800. Is 800 enough for me to get there? I know I just said a lot in a very short amount of time, but that is how I think about my investing life. And I think about that in about 6 different ways, because I have 3 children. Each of them are going to go to college. I have one who's almost 16. He's a sophomore, so he and I, his portfolio is primarily very low risk cash type stuff. Every now and then I'll throw some stocks in that I think look good, but that's because of my knowledge. So he's got 2 to 6 years that I need money for, right? Because it's not just the first year of college; it's also the last year of college. So, but my 10-year-old who's got 7 years before he goes, I can be a little more aggressive with him, right? So, but I do that for all my different investment goals, whether it's retirement, whether it's homes, whether it's colleges, whatever it might be. So I have those all planned out on a spreadsheet, and I look at them. I mean, I look at them too much, but that's just because that's what I do. I look at them every day for the most part, but and I wouldn't recommend that. But I'm always knowing what's going on.
Wow. Okay, another one. How do you feel about variable annuities as a way to create fixed income in retirement?
I think variable annuities are great. They provide tax deferred growth. So even though it's not a 401k or an IRA, you're getting the benefit of tax deferral when the markets are doing really well. I still think that some of the hindrances only is that you're just going to be locked into whatever fund investments they have. So you do want to, when you're choosing a variable annuity company, you do want to make sure that there's a wide range of investment alternatives and investment options. And also just watch the fees. If I'm not mistaken, sometimes there's a lot of kind of hefty fees early on in those things, so just be aware of that. And I do recall when I was a broker that ING had a great product, and I don't think it's called Voya now, but I don't even know if they have this product anymore. But if they do, they had this product where every time you would make a new high watermark in your portfolio, so let's say you put in $100,000 and it went to 115,000, and then it went back down to 100,000. When you hit retirement, it would calculate everything off of the 115,000. So it was always like ratcheting up as the performance of the portfolio was doing well. So it kind of was a way to lock that in. I don't know if they still have it. I'm out of the loop completely on that. I just remember that that was a pretty awesome vehicle, and I put a lot of clients into something like that because it made a lot of sense.
Okay. All right. Well, we're losing people now because it's our lunchtime, but our lunchtime webinar. So I want to thank you, Mark, so much for this, and everybody for attending and for all your questions. And please contact, look at Mark's Twitter and his Facebook. His YouTube is excellent. And thank you, Mark, for doing this for us. We really appreciate it. Very
You're
good.
very welcome, Sharon. It's been great to be here. Thank you.
Okay. Thanks a lot, everybody. See you soon.